Good afternoon, Quasar Markets Live. I am back with the president of the Blue Collar Investing Corporation, Dr. Alan Ellman, on his fifth in a series on covered calls here. Dr. Ellman, how are you doing today?
Wonderful. It's always good to be with you, Howard.
Thank you, thank you. So today we're going to talk. We talked a lot about exit strategies last week. This week we're going to talk a little bit about assignment risk, what it is, and how we manage it. So I'm going to leave it right off to you.
Okay. Well, it's interesting when we discuss assignment risk, that kind of assumes that we are concerned about selling our underlying shares, whether they're stocks or exchange traded funds. So, very frequently, and particularly with me, when you're doing traditional covered call writing, Howard, I could care less if my shares are sold early.
Right.
Actually, it's a bonus. And the reason why I consider it a bonus is because it means that I've maximized my trade. Let's say I bought a stock at 48, sold a 50 call. It goes past 50 and then it's exercised. Well, I got my premium and I got my share appreciation from 48 to 50, and not only that, now I have a bonus. Why? Because now I have all the cash back from the sale of that stock, which I can now reinvest and get a second and third income stream. So if we can move on to the next slide, Howard, if we were going to define uh, assignment risk for covered call writing, that basically means that it's the possibility of our shares being sold usually early, and it makes the assumption that we don't want our shares sold. So that's a second component. Traditional covered call writing, you don't really care if your shares are sold.
Right.
Think about it. What's our goal, right? It's to make money. And if we're making money, we maximized our trade. If our shares are sold, now we have the cash back to reinvest. So that's a bonus for me. But there are times there are times when we want to keep that underlying. Now, I would call that portfolio overwriting, where we have a portfolio of stocks that we want to retain. And we have two goals in mind now. One, premium, generating cash flow by
Right.
selling premium. That's constant throughout all forms of covered call writing. But now we're adding a second component, Howard, and that's share retention. So because our options are what's called American style, that means they can hypothetically be exercised at any time from when we click that keypad on our computer
Yep.
to 4 p.m. Eastern time on expiration Friday. But early exercise is very, very rare. I mean, I can probably count on two hands how many times it's happened to me over the last 30 years of covered call writing.
I
So it's
think that's
very,
important. I do want to interrupt you for 1 second because I do think that's a very important thing to mention is here because you have traded so many options because people ask those questions all the time and they tend to get nervous. I'm going to be assigned. I'm going to be assigned. You know, and like you said, what I wanted to do is just slow down so people understand that number one, with your extra strategies we talked about last week, you talk about how to handle some of that, and we're getting into it today. What to do if that does happen. But what I love about your system is that you also take into account the cost of your dollars being sort of tied up in a trade. I noticed, and that's why is that one of the reasons you don't mind when it's taken away early?
the main reason I don't mind when it's taken away early is because that means, by definition, that I've maximized my trade.
Okay.
You're not going to get an assignment when that strike price is still much higher out of the money. That's not going to happen because
Right.
whoever then exercised that would be losing money. So that's not going to happen. It will happen when the strike price is in the money, the stock price higher than the
Absolutely.
strike price. So that means that the option buyer is going to capture that intrinsic value. So if let's say the 50 call strike was sold and the stock is trading at 52, if the option buyer, not us, exercises that option at 50 and it's trading at market at 52, they have an unrealized gain of $2 a share. That's when it might happen. But again, early exercise is extremely rare. And as you see, in the last bullet on the screenshot,
Yeah.
when it does happen, it's almost always associated with an ex dividend date. Now, that's the date you must own the shares in order to be eligible to get that dividend. It's not the
Right.
actual distribution date, it's the ex dividend date. So that's why you should avoid ex dividend dates if share retention is critical to your strategy goals. And if that particular stock or ETF has weekly options associated with it, that's just such an easy way of circumnavigating around those X dates. And
Right.
of course, earnings dates, I mentioned this previously in our previous discussions, must always be
Be
avoided. So
absolutely
weekly options are just a wonderful way of accomplishing that.
excellent. Excellent.
So again, if we add that second component, Howard, of share retention being a strategy goal,
Yeah.
then that strategy I refer to as portfolio overriding. And it usually applies to investors, and I'm sure many of your members out there fall into this category, that own shares at a very low cost basis. They've had it for a gazillion years. It's appreciated dramatically, that perhaps generating dividend income, which they want to keep getting, but they would like to have an additional income stream by writing covered calls. And that is very, very doable as long as you could craft the strategy to this additional goal of share retention,
Right.
which means that we're going to write strike prices much higher, much deeper out of the money than current market value. So I don't know if you could see my hands, but
Yeah.
traditional, here's the stock price, you might write a call here, but for portfolio overriding, you might write a call all the way up here. That means two things: much less likely to be subject to exercise
Yeah.
because the price of the stock has to go all the way up to that strike and then beyond, but also less premium. So you have to be willing to accept lower premiums if share retention is critical. Perhaps you want to avoid negative capital gains if you're trading in non-sheltered accounts. So I'm going to give you a reasonable goal now,
Yeah.
would be about 4 to 10% a year over and above whatever appreciation you're normally getting from that portfolio and dividend income, over and above that. So if that's our goal and we're doing monthlies, it would be about a 0.5% a month. And if you're doing weeklies, 0.12% a week. And that's giving you like a guideline, and it's not etched in stone as to what your goals should be.
Right.
So of course we're going to use, again, deep, deep out of the money strikes, which means low delta. For those of you viewers who understand delta, I'll be showing a screenshot of how to find that information
Awesome.
shortly. And then once again, avoiding those two dates I've been alluding to in the last several of our discussions: X dates, which is not an issue for exchange traded funds
Right.
because, I mean, earnings dates, because ETFs don't give earnings, but some do give dividends. So you'd
Yep.
have to avoid those for both stocks and ETFs.
Absolutely. Um, do you ever trade? I was noticing that CME was talking about one of their new index funds that they're doing that is using European options as its close. So do you avoid those completely?
Yes,
Okay.
you know, Howard, it's it's the old expression: you stick with what works for you.
Right.
And for 30 years, I've been using American style options for stocks and ETFs, and I mean, it's really, I can't tell you what a difference it's made in my life
Sure.
and my family's life. So I don't really look for other ways to invest because this has worked so well for me.
Absolutely. There's no right. There's no reason, like they say, to change the way the wheel works, and it works so well. Absolutely.
Okay, so a lot of investors worry about early exercise if share retention is one of their goals. But I'm here to tell you that it is super duper rare that that's going to happen, early exercise. And here are the
Right.
reasons why. First of all, the call buyer, now remember, we're the sellers when we write covered calls. The call buyer can keep the cash in a broker interest bearing account all the way up to the last minute, 4 p.m. Eastern time on expiration Friday. So they don't have to make a commitment. They are in control of those shares up until expiration. And if they did exercise and buy the shares at that greater price, well, now they're exposed to greater capital risk
Yeah.
because the stock price obviously is much greater than the option price. So that's another reason. Now, a trickier reason, Howard, and I wanted to put this in here to be thorough, although it might not click with some of your viewers who are not totally familiar with options and covered call writing in particular. But the call buyer would actually make more money selling the option than exercising the option and capturing the intrinsic value component. In other words, let's go back to what I said before. If we have a strike of 50 and the stock is trading at 52, and the option buyer exercises that, now they own the shares at 50, they're trading at 52, so they have an unrealized gain of $2 a share. But that option premium always has a time value component attached to it. Let's say 50 cents in this case. I'm just making that up. Well, the option buyer can exercise and have an unrealized gain of $2 or sell the option for 250.
Right.
So that's another reason why early exercise is usually doesn't happen. But the main reason I highlighted in yellow in this screenshot here is that most call buyers don't want to be share owners.
Right.
They want to be directionally correct and leverage those options to hit grand slam home runs. And when you're investing a very small amount of money per option, and if you're directionally correct, well, then you could make a lot of money, but also you're incurring greater risk
Risk.
because you
Absolutely.
have time value erosion against you, and you also have to make back the amount that you paid for the option before you actually start making money. But it is a way to generate much greater returns than you can capture with covered call writing.
Yeah,
And
without a doubt.
typically,
I tend to be an option trader, as you know, a little bit. And I'm never buying usually the underlying option, the underlying shares, even if it does, like you said. I just today sold some covered calls that I had on a covered call spread on Mara because it hit, it's the risk reward at this point now is no longer in my favor. It's hit most of the profit that it can hit to the top of that call spread. So I take it out. But yeah, like you said, I think that's a big part that people don't understand. So many traders are using this as their tool, not the way that you do, and therefore that's why you also don't see that exercise happen very often, in my opinion.
it's very rare, and
Yeah.
it's usually the result of investor error. A lot of times an investor will exercise the option to capture the dividend, but the time value component of that option was actually greater than the dividend itself.
Right.
So really, they've lost money, but they don't even realize it. So it's
Yeah.
important to understand all the mechanics of these option trades. And once you do, then you'll know the right thing to do. But as I said, if share retention isn't important, have my stock, have a nice life. Goodbye, give me my money, and I'm reinvesting that. And now I have another income stream that I wasn't counting on.
Absolutely. Absolutely.
Now, another reason for exercise would be if at expiration the price of the stock has gone higher than the strike price. And that means even if it's by a penny, Howard, that option will be exercised on the Saturday after expiration Friday. You'll see it, the shares gone in your brokerage account, and you'll see the extra cash in your brokerage account.
Right.
Now, let's say, again, you don't want your shares sold. Here's what you do. It's called rolling the option. You could buy back before 4 p.m. Eastern time on expiration Friday, buy back that option, right? Now, all you are is a share owner. And then once you buy back the option, now you're free to sell another option with a later date on it. You could roll out, let's say, if you're doing monthlies, from the December 50 call, buy back before 4 p.m., and then immediately sell the January 50 call, and you will be getting a time value credit for that,
Right.
right? So that's a defensive play because that 50 strike is in the money, so you have a little protection there. Or you could roll out and up to a higher strike. So you buy back the December 50 call and you sell the January 55 call.
Yeah.
And so we have spreadsheets that will actually do all the calculations to see if it meets what your goal is. In my case, for traditional, I start out all my trades with a time value profit, initial profit of 2 to 4% a month. I won't go
Okay.
higher than six. I'll go up to six in a raging bull market, but never higher because it's too risky for my personal risk tolerance. But
Okay.
generally speaking, 2 to 4% a month. If I'm doing weeklies, then it's 1/4 that. So it's a 0.5%
Point.
to 1% a month. And then for weeklies, I just divide that. So rolling the option is a very standard way of avoiding exercise when the strike price is in the money at expiration.
Absolutely. That makes complete sense to me. You actually give us an example here.
I selected Chipotle Mexican Grill here on. I made this screenshot on November 12th, so about 10 days ago. And Chipotle was trading, ticker CMG was trading at 60.02. And we're looking at the December 20th, 24 expiration, about 5 weeks out. Okay. So if you take a look at the far right column in the yellow field there,
Yeah.
we're looking at the $66 out of the money, higher than current market value strike. Now, if you take a look in the delta column, you'll see that the delta is 17%. Now, what that means is one of the definitions of delta is the approximate, underline the word approximate, probability of the strike expiring in the money, which means subject to exercise. So in this particular case, that 66 strike has a 17% approximate probability of expiring in the money. In other words, Chipotle going from 60.02 to above that 66 strike. And that's something in this situation you don't want if you want to retain your shares.
Right.
Keep in mind, though, we can always roll the option.
Yeah.
Let's set that aside for a moment. That means there's an 83% probability that we won't even have to deal with rolling the option. Now,
Yep.
you could see in the bid column that it's 40 cent. You're getting a 40 cent return per share, $40 per contract. Now, just as an aside, Howard, let me say this: you could see the spread is 40 cents to 55 cents. Uh, Whenever the spread is more than 10 cents, I always negotiate with the market maker for a better price. So I would put in a limit order at probably 45 cents here. But
Okay.
let's use 40, and maybe we could talk about that sometime in the future.
Absolutely.
There's something called the show or fill rule, which allows us to negotiate with the market maker. But we'll use, in this example for today's discussion, 40 cents. And I believe I have it calculated out in the next screenshot. Yes. Okay. So in the top row is where you enter your trade. So you'll notice in the blue cells in the middle, Chipotle was trading at 60.02. We sell the deep out of the money 66 call for 40 cents. The
Yep.
spreadsheet, our trade management calculator, which is, by the way, a must for everyone using covered calls or cash secured puts. I piggyback that on top of the initial calculations, which shows that if taken through contract expiration, that it's a 39-day trade circled in red there. And in the brown cells are the initial calculations. So
Yep.
you get a 0.67% 39-day return, which annualizes out to 6.24%. Remember, our target goal for portfolio overwriting is 4 to 10%. So that meets that guideline. Now, the important thing I want to show you here, Howard, and your viewers, is in that purple cell on the bottom right.
Yep.
And that shows that we have an opportunity for an additional 9.96% if Chipotle moves from 60.02 up to or beyond that 66 strike. So there's an opportunity for more than a 10% 39-day return. Of course, most of that is share appreciation. But again, what is our goal? Our goal is to generate cash flow that we didn't have before and retain our shares. I
Yep.
would shoot for a much, much higher return if I was doing traditional covered call writing where I didn't care about share retention.
Right. That does make sense. It's still, I mean, 10% upside.
So, Howard, if I could just summarize for your viewers here, assignment risk is only a risk if you want to keep the shares.
Right.
Otherwise, who cares, right? Now, I call that portfolio overriding when you add this additional component into the equation where we now have two pre-stated goals. Generate cash flow, which is what I would define as my goal for traditional, plus share retention. What do? We use deeper out of the money call strikes, much higher than current market value, with the understanding that our premiums are going to be lower. Right?
Right.
That's the trade. Um, and that gives us greater opportunity, as you just saw with Chipotle, for share price acceleration. In case of Chipotle, was nearly 10%
Yep.
opportunity there. Now, delta, which I show you in this screenshot, is one way of quantifying our risk. In this case, it was 17%, but really less when you factor in we could roll the option,
Yeah.
which will completely take exercise off the table. And again, early exercise, just avoid ex-dividend dates. Will it
Yeah.
happen if you trade tens of thousands of options like I have over the last 30 years? Yeah, it'll happen, but
Absolutely.
so infrequently that it's not worth mentioning. And
That
once again, the two key dates to avoid are earnings and ex-dividend dates.
Without a doubt. So, one question I have is, with your strategy, do you tend to make that decision as you enter the trade at the very beginning, or does it sometimes evolve as to whether or not you want to retain those shares? Is it based on how the market's moving? Like right now, when everything's sort of on a blow off top, you might be more willing to do that than at other times, or does it just how you're interpreting the play on a stock to stock basis?
Well, when we have a strategy, we have to define our goals and our parameters for that particular strategy. For me, I do traditional covered call writing almost 100% of the time. I trade a lot in sheltered accounts, so I'm not concerned about selling a stock and having to pay any capital gains or anything
Right.
like that. So and also, like I said earlier in our discussion, Howard, I almost would love. I wish it would happen more often that my shares are actually sold.
Yeah.
But to a lot of retail investors, somehow they kind of categorize assignment as a negative. And if you think about it, it's really not a negative at all if your only goal is to generate cash flow.
Uh,
We don't care about the stock or the ETF at all. I have
Right.
no loyalty to any stock or ETF ever, and I haven't over 30 years. No loyalty.
So
I'm just
important to say
leveraging that.
that, though. Too many traders get so emotionally tied to a stock that has been a strong performer. Especially, do you find that I find it more with newer traders have that affinity? It made me money once. They go back to it too many times, and they hold it too long.
Well, here's the thing that I've seen over and over again. I'm sure you have too, Howard. So an investor invests in a particular stock, right? The stock price goes down. Now they're saying to themselves, I'm going to hang on until it comes back up again. And it goes lower. Let's think Bear Stearns for a minute,
Sure.
okay? And you say to yourself, well, this has been a high flyer, like you were just saying before. It's got to come back. It's got to come back. And it goes lower and it goes lower. So here's my philosophical response to that kind of thinking. We really care about the stock? No, we care about the cash invested in that stock. So
Absolutely.
let's say you had $10,000 worth of stock, and then a month later you have $8,000 worth of stock because the price went down. What I say to myself is it going to come back up? No, I don't say that. I say to myself, well, I used to have 10 grand. Today I have 8 grand. Where is that $8,000 best placed? In this same security? Maybe it is. Or in a better performing security? Probably it is. So at some point in time, I will take a loss and take that cash, which is the only thing I care about, and put it in a better performing security. But so many retail investors, you know all about dollar averaging
Yeah.
lower.
Oh
You
yeah.
have a stock at 50, and it goes to 40, you buy another 100 shares at 40. So now your average cost basis is 45. So you're throwing good money to bad.
Without
Don't
a
do
doubt,
that.
it's one of the biggest mistakes that I see, like you just said, is, and that people don't make that. It took me a while to learn that. I'm going to be honest with you, where you have to have that honest discussion. Is this the best use of my funds? We all only have X amount of funds to put towards our investing. So that's an important question that I think traders don't ask themselves enough. So I love that you just brought that up because it is such an important teaching tip for our viewers is that the idea is to maximize your returns on the money that you have to invest. And sometimes the one that just went down 30% isn't the answer. It's getting into a new position in a new stock. There's 9,500 of them out there, and there's always another opportunity.
Yeah, well, also when you're in a covered call position, and the stock price is going down, there are mitigating exit strategies you could use
Right.
to decrease your losses. So it's not just a matter of getting out of the total trade, short call and long stock, but you can actually use options to mitigate losses on the way down. And then, of course, there could come a point in time when you say, you know what, I screened the heck out of this stock, but it's not performing the way I anticipated. It's time to take my hit, get the cash back, and now reinvest it in a better performer. But that means mastering a position management skill
Absolutely.
set, which you must do for any strategy. I mean, you're a crypto expert. I mean, you know this. There are times when you have to take action to adjust your positions, and that's what investors need to do before they invest even one penny of their hard-earned money. What if this happens? What if that? What am I going to do? That has to be pre-planned before you enter the trade.
Another great point. You just are hitting grand slam after you say you only go for singles and doubles, but with me, you're hitting grand slams on all these answers because I don't know that my viewers they get tired of me saying some of these things. So when you repeat them or our other experts here, it really helps. But that is, if you don't have all of sort of the contingencies laid out, then you're setting yourself up to fail too many times. Because once that thing starts moving and the money is moving in front of you, as we all know, we all get a little bit more scared. The heart gets a little bit, going and we get tense. So you want to make those decisions with a clearer mind when the market's not necessarily, when you're not in the trade yet. You want to set up for these contingencies. And what I'll point out is because I have one of your books, is not only do you set up for those contingencies, but you have 27 chapters on how to do that. And that's what people don't understand about your system. That's what's blown me away is that you have really gone and taken so many of the different parts that I see as mistakes made by different investors, and you've really taken them out of the mix.
Also, in addition to that, Howard, in terms of bottom line improvement with exit strategies, from a psychological vantage point, it makes life so much simpler for you because if A happens and it's a negative, well, you know exactly if A happens, you're going to do B because
Yeah.
you've already decided that ahead of time. So there's no emotional component to your trading at all. You
Right.
just know the right thing to do. And so that takes so much stress out of your life. Now, not every trade is going to be a winning trade, but many more will be winners than losers if you account for uh, which stock or ETF, which option, and then, of course, the position management aspect of it. So it's a psychological aspect to this as well.
Absolutely, absolutely. Without a doubt, emotions can take over. So thinking about them before things happen is definitely the best way for a trader to get ready. That's why I know we've talked about this even with your strategy that seems very straightforward because you lay everything out for them. You start with paper trading, you start with paper trading, you start with paper trading,
Yeah.
before you get into the live trading because when you hit it that first time, I don't care who you are, how experienced you think that you are when you're using a new strategy or learning new techniques, you really want to give yourself time to master them.
Yeah, nobody's perfect right at the beginning. I mean, I've been doing this for 30 years. I'm a lot better today at it than I was 30 years ago. But even 30 years ago, I was still beating the market when I was
Right.
so-so at this. So yeah, that's what I want for your viewers. I want them to go from point A to point B where I am in a much quicker time frame than it took me. It took me several years to get all this figured out. And for the last 25 years or so, I've been on cruise control.
I have to ask, we haven't talked enough about how do our viewers find you? How do they get involved in the Blue Collar Investing Corp? In fact, I'm going to pull up your website here. Give me 1 second to get it on the screen. You're looking at my lovely father while we do that. Again,
Whose
I didn't
dogs
get
are those?
prepared and had this up for us, so give me 1 second. I apologize.
Are those your dogs or his dogs?
Those are my two puppies that passed away, unfortunately. I have another one
Oh,
of the same style of Boinkin Spaniels. But those were my dogs. I love little brown dogs, they're called.
you're a dog lover.
I am without a doubt.
So this is my website. So let me just say this. We have a lot of free resources on our website, and you could see free training link in the middle there. We have an overview course on covered call writing. You could see beginners covered calls. We have one for cash secured puts. So all you have to do is just put your email at that bottom there and your name and email, and just click on "Let Me In." It's down there someplace in that blue
Yep,
area,
right here.
and you can take that course. There are 8 to 12 minute videos. It gives you an overview of covered call writing or put selling, and you could download the slides if you want, and take them one or two, or go through the whole thing, whatever you want to do. Come back later. So also to the right of the free training is our blog link, and I write an article every week. You can look on the top and click on that link at the top there.
Yep,
And I write an article every week. I spend a couple of hours writing it. So you could see that last one was generating, what does it say, greater than maximum returns. Hey, using exit strategies, what we were
yep,
just talking about. So all of these articles have educational value to them. And so it comes free. And if you scroll down a little bit more, Howard, on the right side, please,
yep.
there should be a box. Keep going. Somewhere down there, there should be a box that allows you to get our free
Oh,
newsletter
there
right
it is.
there.
Yep,
Yeah.
absolutely.
So if you put in your name and email, then you'll be sent our free newsletter, which are these articles. You'll get it into your email box every Sunday morning, 10 a.m. Eastern time.
Oh,
And
that's
it's
amazing.
totally
Perfect.
free.
Get ready for the week before the week starts.
Yep.
I
And
do
again,
suggest
for more
everybody takes
information,
it's one thing that I point out to our viewers all the time. Take advantage of these resources. One thing I have to say is that Big Beat, when he started Quasar Markets, and even before then, he has put together a group of friends like Dr. Ellman here, who are the best, very best at teaching people on how to invest, how to properly invest their money. And you can see all of these resources. As you know, I've been asking you questions about them because I've been going through a lot of these things, and it really is great information. I'll tell you, you make things easy to digest, and you do them. What I like is, like you said, 12, 15-minute videos. I don't feel completely overwhelmed. I go through some of these with some other educators and coaches out there, and after, you're 45 minutes in, and my head's just like, I don't even know what's going on anymore. So I think you've really hit that nice spot where you get the information out in a timely manner, like we try to do here, a half hour or so at the most. And I can't stress enough, people. Please go visit this site and check out these tools. I know that you're going to want his full course because he sent me some of the other materials already that I've been going through this weekend. And the spreadsheets, the tools that the blue collar investor gives you, make it like he said. I don't want to use the words easy, but what I want to say is it's set up systematically in a way that it's easy to follow along to. It's easy to understand what you should be doing. The math behind it, the science behind it, all that. Not easy. I won't say that is easy, but what you've done is you've taken all that sort of out of the works and made it a lot easier for people to get their, heads around it without a doubt.
thank you very much, Howard. I appreciate that. I started out as a retail investor, not from the trading pits. So I'm explaining it in a way that I believe most retail investors could understand it, although we do have quite a number of professionals that follow us as well.
Absolutely. Well, thank you so much again for a great session, Dr. Ellman. We will see you again next week. We'll have our next session. And have a great Thanksgiving. Any last words before the holiday for our viewers?
Well, I want to wish everyone a good holiday. And as far as what I'm doing on this shortened week, I'm just going to, after we get off this call, I'm going to sell some weekly cash secured puts, give me a little protection to the downside, and generate maybe $1 or $2,000 over the next hour or two. And and then I'll get back into my normal trading mode next week. So, Howard, thank you for the invitation to participate in these discussions.
Absolutely. Thank you so much for giving us some of your time, and we will see you all tomorrow on Quasar Markets Live.